Oh, welcome into another daily editorial here on the KE Report. I am chatting with Jordan Roy-Byrne, and we are recording this just slightly before the upcoming Fed meeting, but we're not really going to talk about the Fed here. We are going to first look at the U.S. equity markets. And Jordan, you and I don't usually talk about the U.S. markets, but you sent out this update to subscribers this morning that I found very interesting and I think spot on as to how these markets are going to play out. What you outlined is the fact that the U.S. markets, no doubt about it, have been under some serious pressure, and they are due for some sort of a bounce back. But when we look back into how other bear markets have started, you're seeing some similarities where there's some shakiness at the end of a year, the markets pull back, and then the rebound that they get into the new year. In about the first half of the new year, it moves up, but it makes a lower high, and that almost confirms the fact that the markets are moving down and the trend has changed. Can you outline this overall concept and how you see it playing out right now, please?
Well, Corey, the stock market obviously lost the 200-day moving average recently, but it also lost the 400-day moving average, and it lost that after it had this bearish consolidation from October into December. I mean, it could be a bear flag or just continuation triangle. It's kind of difficult. Whatever it is, the price action of the last couple of months was bearish. The market broke down from that. It's trading at 25.66 right now. I do have some potential downside targets in the 2400s. I don't want to give everything away, but there still is a little bit more downside here in the stock market as far as the price action and those targets and the support that it's lost, in addition to various indicators that I use to measure oversold extremes. And some of those are things like the VIX, and some of them are breadth indicators like the number of new 52-week lows or the percentage of stocks trading above the 50-day moving average. So I got 5 or 6 of those things that I'm looking at, and a couple of them have reached an oversold extreme. Some of them have, the other ones have not, I should say. So I am looking for some more weakness in the stock market, but not that much more weakness. I mean, if we get a little bit more selling, a little bit more downside here over the next couple days or week or so, we could come to a level where there is technical support. And in addition to that, these breadth indicators, all of them could be at an oversold extreme. And so that's what I'm looking for, or anticipating, I should say, over the coming days, over the next week or two. And if that happens, that would set up a rally in the stock market, obviously. And if you look at recent bear markets or difficult years, go back to 2011, 2008, 2007, 2002, 2001. I don't have 2015 and 2016 in front of me. But if I remember correctly, those markets made either highs or often like a secondary peak in the March to May timeframe. Now, I'm not a huge person on seasonality because it's not really objective, in my opinion. I mean, what really matters is how is the market's overall trend. But I find it curious that in recent bear markets, the stock market made a secondary peak often in the spring timeframe. And if you look at what's happening now, well, it looks like the market's probably setting up for a good January, February. But as you said, I mean, there's potential for it to make a lower high. It's going to be difficult for the market to get back to that high. We could see a lower high in the spring, and that would resemble bear markets of the past. However, we're just projecting ahead over the next couple of months, so there's obviously things that could change that. The price action could change, but here and now, Corey, I think the market, we're going to see a little bit more downside, and then probably a decent bounce to start the year.
Okay. Yeah, I agree with you on that one, Jordan. And that will impact kind of the Fed as we go into next year. But you know what? Don't just expect these markets to drop straight down, because that's just not what happens, especially when we see that change in trend and that recent run, or the run that is coming up. What's important is to see just how far it goes, how high it goes. I do also want to talk about the precious metals and the nuance that we're seeing, at least recently, and it might not be every day, but we are generally seeing gold rise while the US dollar is also still rising. I know everyone argues about this inverse correlation, but something you and I were talking about months ago is the fact that there is a good reason and a good setup for gold and the US dollar to be moving higher. Can you please share?
Yes. Well, the first of all, if we look at how gold is performing against foreign currencies, it's made a very strong move over the last couple months. However, it is in an area of strong resistance going back over the last 18 months or so. So I think potentially we could see, the strength of gold against foreign currencies for the time being, it looks like it's probably going to come to an end. But if we're just looking at gold, as I've said, in looking at history and really studying it, the market is really set up to do really well when the Fed starts cutting rates again. We know that it usually bottoms around the time they stop hiking rates, but it really gets going when they start cutting rates. And so it looks like to me, big picture, gold is set up to do really well into 2020 and over the next year or two that follows that. Now, if you look at the dollar in the last couple cycles, the dollar actually peaked well after the Fed stopped hiking rates. The dollar peaked in early 2009, and I believe their last rate hike was in 2006 or maybe early 2007. But still, that's 2+ years. And you go back to the cycle before that, the dollar peaked in the summer of 2001. I think the last rate hike was in the summer of 2000. So you shouldn't automatically make the assumption that when the Fed stops hiking rates, that's going to be the peak in the dollar. History shows that's often not the case. And if there's problems overseas, that could be bullish for the dollar, regardless of if the Fed is hiking or cutting. So, and the last point on this, Corey, is in studying history, usually there could be a 4 or 5 month period where the dollar and gold go up together when gold bottoms. So gold usually bottoms first, and then the dollar peaks 4 or 5 months later. We have no idea what's going to happen this time around. Maybe it'll be 4 or 5 months again. But who knows? Maybe it'll be 12 months or even 18 months. We just don't know. There's a lot of people thinking that it could be a lot more this time around. So, I still think we have some work to do with gold, but the conditions are definitely trending in the right direction for the bulls. But there's some more work to do there. The dollar right now in the short term looks like it's going to correct some, but I wouldn't want to be a big dollar bear yet. There's a lot of things that have to happen first before we can claim that this dollar bull market's over.
Exactly. But the one thing that has been pretty obvious at the tail end of this year is move into what are so-called safer assets. And I know some people don't like that whole safe haven call, but when you do see the dollar moving higher, treasuries moving higher, and gold moving higher, it is showing a general shift in where investors are putting their money, isn't it?
Yes, it is.
Now, what would you be watching most closely as we start 2019 in terms of confirming this narrative that we think could play out, or throwing it aside and us needing to say, you know what, maybe the end of last year was just kind of a nuance?
Well, I think the key is obviously, I hate to say this because, I hate the Fed and the obsession over, Fed transcripts and what they say and, how the media obsesses over everything they do. But Fed policy is going to play a big role. And obviously the stock market will influence that greatly. So I would think the key is probably the stock market first and foremost, because if we get a strong counter trend rally, something that lasts beyond a couple months, that is going to bring into play the potential for another rate hike. And that obviously would pressure precious metals for, at least the first half of next year. If it's an even stronger rally than you or I think, then maybe the Fed will be able to hike twice. And that would, push off the start of the gold bull market. But on the other hand, maybe they are done, or maybe they can only do one more hike. Then that would obviously be bullish for precious metals. Uh, Generally speaking, I mean, a few months down the road after they do that last hike, if there is one more hike to be done. So it's a fluid situation, Corey. But I do think, we've probably, unless there's some very strong dollar move higher and the Fed is able to hike more than one more time, unless that, other than in that scenario, the worst is over for precious metals. And the stock market looks like we're in the early stages of a bear market. So I think it would take a lot to change those statements.
Okay. Yeah, so things are definitely lining up more positively for the precious metals, but again, this is a process. Something you were pointing out there, that it can take much longer than people want it to, especially the gold bugs, but we're talking potentially even over a year for this general change to happen and more money to flow in, but one step at a time. Especially for gold, it needs to take out that about 1260 to 1270 level and then start to look into the 1300s and again ultimately make it up to about that 1375 level, because we're still a long way away from there. And it has been encouraging to end the year for the precious metals and some of the stocks, but we're not seeing a broad-based recovery in terms of the stocks. I know that you have some of your own indexes that you have put together with the junior stocks. Can you share some insights on those in terms of the lack of a broad-based recovery?
Yeah, the breadth has been really bad. I mean, honestly, I've been talking about it GDX, and I'm sure our listeners and my subscribers are sick of me pointing out the bad breadth. But it's not just been poor at GDX; it's been really bad in GDXJ. I mean, and that's a big reason why it hasn't rallied as much. I have an index of 55 juniors that I track the breadth indicators for, and in looking at the percentage of that basket that's closed above the 20-day, 50-day, and 200-day, the numbers are really, really poor for the juniors. And about half of that basket are really small juniors, such as the ones we like to talk about. And the breadth in those is just really bad. And that's because they just haven't done much over the last couple months. Even though the sector has rallied, the real small juniors, like the TSX Venture juniors, they haven't done anything. So even though I'm concerned that precious metals could be making an interim peak here, and they might, go sideways to lower for a little while, I don't think that will be that negative for a group of stocks that, number one, hasn't done anything over the last couple months, and secondly, they're going to get the rebound effect from tax loss selling, where they'll rally in January. So yeah, the breadth has been bad in GDX and also the big stocks. I mean, there've been 6 or 7 big stocks that have been carrying the indices. I mean, such as Anglo Gold, Franco, Newmont, Barrick, Kirkland Lake, Rand Gold. So just off the top of my head, they've been carrying GDX, the Huey, and those indices. So the breadth has been bad all around. And Corey, that's another big reason why the market is not ready for a bull market, at least in the stocks. More something else is needed and time is probably the answer to get the weaker stocks in the sector. They need to go sideways, strengthen, bottom out, whatever. They just need to strengthen and at some point start rising with the strong stocks. That's when you'll get a real bull market, because right now it's just being carried by those 6 or 7 big stocks.
Yes, it is. And that continues to be one of the issues, I think, with the overall narrative of gold just screaming higher. But it definitely has been, again, an encouraging end to the year, something that you and I will be following up on early next year. And very soon we're going to be hearing from the Fed. So let's see the crazy market moves that we get and the swings that undoubtedly come after we get that Fed statement and even throughout the press conference. Jordan, great chatting with you. Thanks for all the time you've spent with us in 2018. I look forward to catching up with you and continuing our discussions next year.